Today, the cliff is nearer now. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 9th of February 2019, our digest of the latest finance and property news with a distinctively Australian flavour. This was a mega week in which the Royal Commission reported, mortgage brokers were crushed, the RBA cut growth expectations, and we saw more confirmation of the pressures on households. And NAB lost both its chairman and CEO. So let's get started. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, here's the link, or consider joining our Patreon program. Again, here is the link. We really appreciate your support to help us to continue to make great content. And the link is also in the comments below. The final report from the Royal Commission was disappointing in that whilst 20-plus companies will be referred for potential criminal proceedings, and NAB was called out for not getting it, and the 76 recommendations may be worthy, we discussed the recommendations in more detail in our post, A Banking Royal Commission Special Report. The report failed to address two critical issues. Hayne has left lending practices where they are. Yes, the banks have tighter standards now, at least temporarily, but he left the household expenditure measure benchmark question hanging and failed to address the question of conflict between providing advice and selling financial services products, which was at the heart of the hearings. Too often, advice led to customers buying products which maximised the income of advisors and firms when they were not necessarily in the best interests of said customers. See our post, Why the Royal Commission Report is a Fail. Paul Keating, the architect of financial deregulation in the 1980s, was quoted as saying in The Australian, the Royal Commissioner should have recommended this conflict between product and advice be prohibited. This he monumentally failed to do. He should have acted upon the examination and the evidence of these serious conflicts of interest. We agree. Finance sector stocks went higher before the report was released, and some are suggesting insiders made $20 billion or so as a result. A leak was denied by the government, of course, but we're not so sure. There were massive stock movements at 11 a.m. on Monday, when, remember, the report was made public after the market is closed at 4 p.m. Mortgage brokers got a shock because their business models are potentially crushed. The Commission proposes that trail commissions, payments in subsequent years for brokers by banks for loans they introduced, should be banned as, quote, they are payments for no value. And in due course, brokers will need to move to a fixed fee arrangement paid for by the borrower, which would make the arrangement more transparent but may restrict competition and swing momentum back to the big banks, which would be set to benefit. I discussed this with mortgage broker and financial advisor Chris Bates. See, what does the Hayne report mean to mortgage brokers and financial advisors? They will also be given a requirement to act in the best interest of their clients, something which is assumed by many customers of brokers today, but which is not currently the case. And so, in summary, Hayne will be remembered more for the exposés in the hearings, where the bad conduct and criminal behaviour of the finance sector were revealed, rather than firm recommendations to make substantive changes. It mostly falls back to the institutions and the regulators to heal themselves. I'm less confident, so expect bad practice to continue. And NAB lost their chairman and CEO. They were both called out as not getting the problem in the bank, and it is possible that other heads will roll as criminal proceedings commence, but I suspect most will remain unpunished. The RBA had a big week with Governor Lowe speaking at the National Press Club on Wednesday and then releasing the statement on monetary policy on Friday. Lowe's view is that economic growth will slow a bit compared with previous forecasts, 3% this year and 2.75% beyond, and he believes income growth will start to lift as the unemployment rate slides further. He thinks that this will be enough to keep the economy ticking over, but despite this, there is now, he says, equal weight to both a fall in the cash rate or a rise ahead. And in the SMOP, there was recognition that falling home prices may have a dampening effect on consumption and growth as the wealth effect dissipates. Many suggest this downside risk is still underplayed. Plus, the new headline inflation number for June 2019 came in at an estimated low of 1.25% in the statement. which is a significant reduction. Damien Boyer at Credit Suisse said, "We cannot help but feel that the RBA is missing something in all of this. Hence its rather shallow downgrades to consumption growth forecast and its optimistic forecast for only a 10% reduction in residential investment this year. If the bank does not understand or admit to the nature of banking and credit problems, it will always think that the economy is healthier than it is. It will always have too high a view of the potency of rate cuts and therefore delay them until the last minute." And Westpac's Bill Evans said of the RBA's move, "This move to a balanced rate outlook is significant because it clearly establishes that the bank is prepared to contemplate rate cuts, a position that has only really emerged recently since the housing markets have reversed. It is also consistent with changes announced by other central banks, notably the US Federal Reserve." Of course, bond rates remain higher in the US than here, which is unusual, and signals higher bank funding costs ahead. This was something which CBA signalled in their results out this week, so I'm expecting more out-of-cycle mortgage rate hikes ahead. My own view has been for some time that cash rate cuts won't have much impact, but thanks to the budget trends, there is capacity for quite big tax cuts to try and stimulate consumption. So I expect the upcoming budget to start that trend, and there will be more fiscal loosening later in the year as the economy weakens further. The latest news on home prices is more of the same. Down, prices are down. CoreLogic's 5-city dwelling price index slid another 0.24% last week. The quarterly declines have risen to 3.57% and values have fallen by 8.5% since their most recent peak, with Sydney down 12.5%, Melbourne down 9% and Perth down 16.7%. Remember, these are averages, and in some areas prices are down more than 20%, with more to come. And the auction results remain in the doldrums on low volumes and clearance rates. The national auction clearance rate dropped 5% to 42.8%. In Sydney, auction clearance fell by 4.2% to 49.5%, though in Melbourne it rose just a tad to 44.3%, both well below the trends from a year ago. And by the way, CBA senior economist Gareth Edge showed the correlation between home prices and jobs growth, which goes counter to the RBA's view that job momentum will support prices. Another reason why we think prices will go on sliding. All of this is in stark contrast to the ME Bank Household Comfort Report out this week. The most shocking chart was the high proportion of households who, according to ME, still think prices will rise. Only 13% of homeowners and 11% of investors expect the value of their properties to fall this year, versus 38% of homeowners and 52% of investors that believe property prices will rise either a little or a lot. Clearly, more should be watching our shows. But then price growth expectations are wired in. Many have never seen falls, and the real estate sector still are saying things are on the turn, and she'll be right. Sorry to disappoint, but there are more falls to come. And by the way, the same report said that it was the renting sector who were feeling more bullish as rents slide. Now, the ANU, as reported in The Australian, said that the average households have seen no gains in their after-tax income since the end of 2010, which was when the economy was emerging from the global financial crisis. According to ANU's Centre for Social Research and Methods, the fall in the past 3 years was greater than during the last recession in 1991-92. In fact, living standards peaked in 2011. There was no improvement for the next 4 years, but income started falling behind rising living costs from late 2015 onwards. Many will not be surprised, and it helps to explain why we think household consumption will continue to fall. A NAB's survey this week also highlighted concerns among households. They said that anxiety increased most over the cost of living, and despite a healthy labour market, concerns over job security also climbed to its highest level since mid-2016. In terms of household finances, retirement remains the big worry, followed by providing for families' future, raising $2,000 for emergency, and medical and healthcare costs. Against this background, almost 4 in 10 Australians said that they had experienced some form of financial hardship last quarter, the highest in 2 years, and importantly, spending plans are being curtailed, which will flow on to lower growth in due course. Next, our own mortgage stress data for January underscored the pressure on households. The long grind in WA continues with more households under financial pressure, but we're seeing further deterioration in other states too. The number of households in severe stress continues to rise. The latest RBA data on household debt to income to September fell a little to 188.6, but remains highly elevated. And the household debt ratio continues to climb to a new record of 139.6, according to the RBA. This shows that household debt to income is still increasing. This high debt level helps to explain the fact that mortgage stress continues to rise across Australia. More than 1,026,000 households are estimated now to be in mortgage stress. That's 5,000 up from last month, and another new record. This equates to more than 31% of owner-occupied borrowers across the country. And in addition, there are more than 25,750 in severe stress, up from 22,000 last month. And we estimate that more than 63,000 households risk 30-day default in the next 12 months, up 1,000 from last month. We continue to see the impact of flat wages growth, rising living costs and higher real mortgage rates, and bank losses are likely to rise a little ahead. See more in our video, Mortgage Stress Exists, Believe It. Despite the popular view that household finances are fine, in fact the continued accumulation of large mortgages compared to income while costs are rising and income static explains the issues we're now seeing. Housing growth is running significantly faster than incomes and inflation, and continued rises in living costs, notably childcare, school fees and electricity prices, are causing significant pain. This despite some relief at the Bowser. Many continue to dip into savings to support their finances, and we see a rise in households seeking help with their finances, including access to debt counsellors and other advice channels. WA was seeing very strong growth in cries for help. Indeed, the ABC reported that the National Debt Helpline said calls had skyrocketed in Western Australia amid epidemics of financial stress. And we note that the Treasurer just announced a review of financial counselling. It will consider gaps and overlaps in current service and adequacy of appropriate delivery models for future funding. And last week, John Adams and I highlighted the possible link between mortgage stress and family violence, as suggested by the police in New South Wales. And finally, in our local roundup, business confidence is also tanking, according to Roy Morgan Research, who released their survey for January. They said that confidence has dropped to its lowest level since August 2015, and it was the worst January result ever. The decline in business confidence comes amidst a slew of poor economic news, with significant declines in house prices in Sydney and Melbourne over the last 12 months, now joined by lower than expected retail trade figures December, they said. This is consistent with the NAB results reported last week. So now to the markets. Locally, the ASX 100 had a good run as the Hayne effect dissipated. The index slid a little on Friday, though, thanks to the RBA's downgrades, slipping 0.3% to end at 5,006, territory not seen since October, and up 3.56% on a year ago. The local volatility index was down 0.29% to 1290 and 30.48% lower than a year ago, reflecting a risk-on peak back then. Since the Fed turned turtle on its interest rate policy, the market's confidence is roaring back. Not surprisingly, the ASX Financials Index was up this week as banks were back in favour, despite a small fall on Friday, to end at 5,911, still 5.71% lower than a year ago. Individual banks moved round a bit, with ANZ up 0.11% on Friday to end at 2689, down 2.79% from a year ago. CBA also rose, up 0.93% on their results, which revealed strong capital but weaker margins and profit below expectations, and ended at 74.75, which is 2.58% lower than a year back. NAB fell following the resignation of the CEO and chairman to end at 24.75. In fact, this is not the first time NAB has lost leadership after a crisis. Their shares were down 12.27% lower than a year ago, suggesting that relative to peers, they have a lot to do to regain market confidence. Their quarter disclosure, which came out on Friday, would not have lifted expectations, as again, margin is under pressure and capital fell. It will be interesting to see if the proposed divestments of NAB's and CBA's wealth businesses continue, given Hayne's weak recommendations. Strategies may yet be reversed. Westpac fell 0.33% on Friday to end at 26.79 and down 10.84% from a year back. They still have their wealth business. Among the regionals, Bank of Queensland rose 0.09% to 10.66, but is still 10.56% down from a year ago. Suncorp fell 0.22% to 13.61, up 3.73% from last year, and Bendigo and Adelaide Bank fell 1.59% to 11.15, up 0.36%. they may be more impacted by the proposals to charge customers for mortgage advice. A&P was down 1.21% on Friday, having had a small bounce from the Royal Commission report, because it will allow them to continue to run their advice and product businesses in tandem. A&P ended at 244 and remains 51.49% lower than a year ago. Macquarie fell 1.23% to 121.57, but is up 19.5% from a year back, benefiting from its international business. Lenders mortgage insurer Genworth was up 1.62% on the latest results, which showed a strong capital position. Even if mortgage delinquencies were a little higher, especially in New South Wales, they ended at 251 and is 10.58% lower than 12 months ago. Given lower mortgage volumes, their growth appears limited, and if household pressures continue, we must expect more defaults ahead. And Mortgage Choice, the aggregator, was hit by the Hayne recommendations on mortgage brokers this week, but rose on Friday up 2.44% to 84 cents, down 62.61% from a year ago. Given that they have advice businesses in their portfolio, I suspect they might do quite well from the changes if they can morph their business effectively. The Aussie ended the week at 70.91, up 0.04%, having been above 72 earlier in the week after the Hayne report came out. But the RBA's neutral stance on future interest rates signals more trouble in the economy, and it dragged the index back. We still expect further falls ahead. It is still 9.89% lower than a year ago. The Aussie gold cross rate rose 0.49% to end at 1,853.59, up 9.97% on a year ago, while the Aussie Bitcoin cross rose 4.88% to 4,672, down 53.42% on a year back. Overseas, at the close, the Dow Jones Industrial Average declined 0.25% to 25,106 and is 1.11% up from a year back. The S&P 500 index gained 0.07% to 2,707 and is up 0.91% from a year ago, and it's risen more than 15% from 20-month lows in December, spurred by a dovish Federal Reserve and largely positive fourth quarter earnings, as well as hopes for an eventual US-China trade deal, despite lingering skepticism over the United States and China reaching a trade deal before the March 1 deadline. Of the S&P 500 companies that have reported quarterly results, 71.5% have beaten profit expectations. But analysts now expect current quarter profit to dip 0.1% from the year before, not the growth of 5.3% estimated at the start of the year. The S&P 100 was down a little to end at 1,190, up 0.28% over the year. The volatility index, which measures the implied volatility of the S&P 500 options, was down 3.97% to 1572 and is down 40.97% from 12 months ago. The S&P Financials Index was down 0.94% on Friday to 427.88 and remains 8.02% down from a year back. Bellwether Goldman Sachs fell 0.73% on Friday to 191.67 and is 24.89% lower than last year. The Nasdaq Composite Index climbed 0.14% to 7,298 on Friday and is up 3.35% from last year at this time. And Apple was up 0.12% to 170.40 and is 7.15% higher than last year. Google's Alphabet fell 0.32% to 1,102 and is 4.78% higher than a year back. Amazon fell 1.62% to 1,588 on Friday, but is 13.95% higher than 12 months ago. And Facebook is up 0.57% to 167.33, down 7.66% from a year back. Intel fell 0.79% to 48.84 and is up 8.52% from last year. Investors remain jittery about trade tensions between the USA and China, which has been the catalyst for the global trade war that rocked equity markets. Although the sides met for talks last week in Washington, there has been no signs of progress. And on Thursday, US stock markets fell after President Trump said that he had no plans to meet with Chinese President Xi before March the 2nd, when further US tariffs are scheduled to be imposed. The Fed's pussycat approach to future rate rises has seen the 10-year bond rate come back, and on Friday it was at 2.63, down 0.76%, and the 3-month rate was at 2.42, up 0.41%. The US dollar index was up 0.13% to 96.64, up 7.04% from last year, while the British pound US dollar slid a little to 1.2945 and is 6.71% lower than 12 months back. The UK FTSE was down 0.32% to 7,071 as the Brexit discussions continue and the deadline looms. It's down 2.55% from a year back. The FTSE Financials Index was down 0.84% to 646, down 3.85% from last year. And the Euro-US dollar was at 1.1331, down 7.53% from 12 months back. The European Commission has projected moderate growth in the EU in 2019, but economic uncertainty has dampened confidence. The forecast lowered its growth estimates for the Eurozone to 1.9% in 2018, down from 2.1% in the November forecast last year. The report highlighted Brexit and the slowdown in China as key sources of uncertainty for European economies, adding that the projections were subject to downside risk. Deutsche Bank was down 2.56% on Friday to 7.223 and is 40.09% down from this time last year. And the Chinese yuan US dollar ended at 0.1483 and is 7.02% lower than last year. Crude oil futures rose a little, up 0.11% to 52.70, but remains 15.08 lower than this time last year. Gold futures were high, up 0.32% to 1,318, down 2.48% from a year ago. Silver was up 0.73% to 1583 and is 3.04% lower than last year, while copper was down 0.55% to 281, down 8.29% from 12 months ago. And finally, the Bitcoin US dollar ended the week at 3,716, up 8.17%, but still 54.69% lower than a year ago. The total capitalization of the derivatives market for the Bitcoin US dollar is $156 million US dollars. Worth bearing in mind how small that market actually is. So in summary, we see the change in the wind, which the Fed triggered earlier in the month, flowing on to strong markets, despite the uncertainties around global growth ahead. Locally, as the dust settles on the Hayne report, we expect bank stocks to remain volatile. Remember that there are still more criminal cases in the works eventually. But meantime, the focus will be on the Australian economy as the leading indicators signal more trouble ahead and the RBA plays catch-up. In this context, there can be little expectation of a rebound in home prices, nor a resurgence of lending for mortgages. I think the current settings will mean falls continue and may accelerate. The next thing to watch for will be unnatural acts, fiscally speaking, when the budget comes down in April before a May election, unless something unexpected resets the timetable. Meanwhile, my advice remains to be very cautious about property. There is no hurry to buy. Falling prices may offer opportunity later, but buying into a falling market, even at these low interest rates, is tricky, and as I've indicated, I expect more out-of-cycle hikes to come. So caution is the watchword. But the good news, bad news, is that the risk of a financial apocalypse is abated in favour of another round of debt creation, which postpones what may well be eventually a significant reset. We will update our scenario soon. And before I go, just a quick reminder that our next live stream event is now scheduled for Tuesday the 19th of February at 8 p.m. Sydney time. Here's the link to the reminder. You can ask me a question live or send them in beforehand. I look forward to seeing you there. And as always, if you like what you've seen here today, please share and like the post and add a comment or question. I read them all. And if you want to join the growing band of subscribers who receive alerts when we release new posts, please do subscribe now by hitting the subscribe bell. And if you've already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.